if you're anything like me, you've seen these types of posts or videos promising you extraordinary results. They say things like, I turned 1,000 into 10,000, how I made 300% in a year, or copy my portfolio, get these returns. It sounds simple, if only it were true. And here are 5 reasons why I believe these recommendations are lies. They profit from your attention, not your success. First, it's in their interest to keep you clicking, watching, and consuming, not to actually help you make money. Each view, each click, generates revenue through advertising. Each comment or interaction increases the chances of being featured on the homepage, thus generating even more views and more revenue. Now, don't get me wrong, there are plenty of creators who are genuinely trying to help people and educate them. But even those can fall into the trap of chasing views over substance. After all, if you're not getting paid to share your knowledge, then you have to be getting paid for something else. And unfortunately, many of these creators are incentivized by sponsorships and affiliate fees. Which brings us to reason number 2. Bold promises. These creators tempt you with unrealistic promises of wealth and success. They claim to have found the secret to effortless profits and speak with such confidence that it seems foolish not to follow them. But what they don't tell you is that markets go up and down. There are bull cycles and bear cycles, and no one can predict which one is coming next. Even the best investors have lost money and suffered setbacks. Warren Buffett has had his fair share of bad investments, and there are plenty of examples of hedge fund managers who underperformed the market. Yet these creators paint this picture of effortless success as if they've discovered some magical formula that guarantees winning. They disregard the importance of risk tolerance and diversification and offer the same advice to everyone regardless of their individual circumstances. A one-size-fits-all blueprint that's destined to fail because markets are unpredictable and individual needs are different. Reason number 3, cherry-picked wins. They showcase their biggest wins and best trades, while hiding their losses and failures. You see stories of people who invested early in Bitcoin or Tesla and became millionaires overnight? And while these stories are true, they fail to mention the countless others who missed out on these opportunities. The truth is that most people don't make millions investing. In fact, most people lose money when they invest for the first time. These creators make it sound so easy. They make it seem like everyone can do it. And they use phrases like luck and believe how lucky I am to minimize the skill and research that went into making those investments. This is what we call survivorship bias. Survivorship bias is a cognitive error that occurs when we focus only on the winners and ignore the losers. For example, if you look at a list of the top mutual funds, you might think that they've all done a great job, right? Well, maybe not. Some of them may have had really good returns, but others might have been on the top 10 list just because they had fewer investors and didn't really do that well. So, in other words, survivorship bias means that we only see the names of the companies that survived, but we don't know about all the ones that failed. It's important to remember that these people are just like you and me. They're trying to make money. And so they want to make it seem like they're really smart and talented, so that we pay attention to them. But it's not always the case. Reason number 4, they downplay the cost. They conveniently ignore taxes, fees, and slippage that eat away at your returns over time. Let's say you buy a stock for $1,000 and it goes up by 10%. That sounds great, right? You made 10% on your investment. But wait a minute. If you bought the stock for $1,000, then a 10% increase is only $100. So you didn't actually make 10% on your initial investment. Only made 10% on the amount you would have had if you didn't pay any fees. In other words, fees reduce the amount of money you make. And so if you want to know how much money you're really making, you need to take into account the fees. This is what we call slippage. Slippage is the difference between the price you expect to pay for a trade and the price you actually pay. When you buy a stock, for example, you might see the current price of the stock is $100 per share. But when you go to buy it, you might end up paying a little bit more or a little bit less than $100 per share. That's because when you place an order to buy a stock, it takes time for that order to be filled. And during that time, the price of the stock could go up or down. So if you're rebuying a stock that's really popular and a lot of people want to buy it, you might end up paying more than you expected to. On the other hand, if you're buying a stock that nobody wants, you might end up paying less than you expected to. Now, you might be thinking, well, why don't I just buy the stock right now? Well, sometimes you can't. For example, let us say you want to buy 100 shares of a company, and the price of the stock is currently $100 per share. You place an order to buy 100 shares at $100 per share, but before your order is filled, the price of the stock goes up to $101 per share. In this case, you'll still end up paying $101 per share for all of your shares. Even though you placed your order at $100 per share. That's because when the price of the stock goes up, the broker will fill your order at the current market price, which is $101 per share. And so in this example, you would have been better off waiting to place your order until the price of the stock went back down to $100 per share. However, if you're buying a stock that's not very popular, you might be able to negotiate a lower price with your broker. For example, let us say you want to buy 100 shares of a company. The price of the stock is currently $100 per share. You place an order to buy 100 shares at $100 per share, but before your order is filled, the price of the stock goes down to $99 per share. In this case, you'll still end up paying $99 per share for all of your shares, even though you placed your order at $100 per share. That's because when the price of the stock goes down, the broker will fill your order at the current market price, which is $99 per share. And so, in this example, you would have been better off placing your order earlier, when the price of the stock was $100 per share. Now, this isn't always the case. Sometimes brokers will execute your order at the average market price, which is the average of the prices at which the stock is trading at the time. This can be helpful if you're rebuying a stock that is very volatile, because it can prevent you from getting too much or too little slippage. Overall, slippage can have a major impact on your investment returns. According to some studies, slippage can account for as much as half of the trading costs for some investors. And so if you're going to be doing a lot of trading, it's important to try to minimize slippage by placing your orders at the best possible times and using limit orders whenever possible. Reason number 5, they obscure the truth and make it difficult to verify their credentials and track record. Their websites might have flashy graphics and testimonials, but lack transparency. When it comes to their background and experience, they make bold claims without providing any evidence or references, leaving you with no way to verify their expertise. These creators often use complex jargon and try to make themselves look more qualified than they really are. They talk about things like technical indicators and candlestick patterns, but they rarely explain what they're talking about in detail. This makes it hard for you to understand what they are actually doing and whether or not it's effective, so they may be reluctant to share their track record or provide any evidence of their success. This is probably because they are trying to hide the fact that they have and been as successful as they claim to be. Or maybe they just don't have a track record because they're new to investing. Either way, it's important to be wary of anyone who is not willing to share their track record or provide evidence of their success. Remember, if it sounds too good to be true, it probably is.
Wow.
So how can you protect yourself from falling for these lies? Well, first, you need to be skeptical of anyone who makes bold promises of easy profits. Remember that markets go up and down and no one can predict the future. Second, you should always do your own research and don't just blindly copy someone else's portfolio. Just because a stock has gone up in the past doesn't mean that it will continue to go up in the future. Third, you should look for evidence of a person's track record and credentials. Has this person written any books or articles? Have they spoken at any conferences? Do they have any relevant experience? Fourth, you should be wary of anyone who is not willing to share their track record or provide evidence of their success. Finally, you should remember that you're not alone. There are plenty of other people out there who are looking for investment advice. If something sounds too good to be true, it probably is. Thank you for watching. And remember, the best investment you can make is in yourself. Keep learning and growing, and you'll be able to achieve your financial goals.